make sure to mute that over here. Okay, we should be live. Hey everyone, welcome to another TraderLion live stream. First things first, let me know if you can hear me clearly, and Ray, if you could go ahead and say something as well, we'll get your mic checked.
Hey guys, how's it going?
And we'll be waiting just a few moments to let people trickle in. While you're at it, leave any questions you have about today's topics down below in the, I guess not down below, but in the chat section. Awesome. Cool. You can hear us fine. That's great. And thanks so much for joining us on this Monday. Looking forward to this. And we'll get started probably around 12:35. So go get something to drink, go get something to eat, and yeah, grab a coffee or something. And while you're waiting as well, make sure to go ahead and leave a like on this live stream and subscribe to the channel. We'll be trying to do this a little bit more often. I just got to bug Ray and convince him to do it every now and then. You know, we could do this monthly or something. That'd be fun. But yeah, make sure to subscribe to the channel so you don't miss any future live streams or any videos as well. And also in the chat, let us know kind of where you're watching from. That's always cool to see as well. And Ray, I'm going to go ahead and tweet it out one more time. And if everybody watching could go ahead and tweet out the video, that would help kind of spread awareness and get more people in here. And we'll get started in just a few moments. I see some Vancouver, Germany, Flagstaff. Hey, Nick, what's up? Switzerland, that's pretty cool. What time is it over at Switzerland? I'm not quite sure. Virginia, nice. Awesome stuff. And Gary's in the chat, Ray. Nice. Cool. Yeah, I think Ray, I think we're good to go. We'll get started and run through today's topics.
Awesome. So the agenda for today is performance mindset based on the comments that you guys gave on Twitter, position sizing, year-to-date trades, EC mindset is one that I feel not a lot of people talk about, how to get back into the market after a correction, and a very simple but powerful slide on the past winners in the market and what common characteristic do they share. Every single winner seems to have this particular characteristic. So I'll start with having a performance mindset. So a lot of what I do, this is what I do in the market to extract an income, is I divide my trading into a process, which is routines. Routines can be daily or weekly routines. And then I have what I call setup. Setup is basically your edge in the market with an entry tactic, and the most important part for performance, which is position sizing, is what makes a setup in the market. And then, are you making money? Is your EC making progress? Is it seeing higher lows and higher highs? And that's what matters at the end of the day. If you're putting in effort, time at the desk, are you being rewarded for what you're doing? And is what you're doing in the market working, or is it not working? And the last piece of the puzzle is identifying your problems and doing PTA. PTA, basically looking back at what you did, the trades you made, how much emotion is involved, how much of your system, which is your edges and entry tactics, do you actually go out and execute in the markets, so that you can have this feedback loop. PTA is what creates that feedback loop so that you could get better. So all of this combined is what creates a performance mindset. If you repeatedly execute your edge, if you repeatedly have these entry tactics that when you see them, you execute upon them, And then the most important part, you size up when it matters most. There's no way that you shouldn't be making progress in the markets. So all of this combined together sort of builds that mindset, especially I would say this particular part, the EC mindset, it sort of gets you to perform in the markets month over month, quarter over quarter, and year over year. And there's really no room for excuses or being mediocre if you're serious about making an income from this. So I'll pause there if there are any specific questions to what a performance mindset is. I'll be happy to answer them. I can also elaborate on some of these specific concepts. For example, for an edge in the markets, for me, it's, relative strength can be an edge. High volume, which I break down into high volume in over a year, highest volume ever, highest volume since last earnings, highest volume since IPO, or highest volume since IPO week. These are things I look for in the markets, and these are common threads that tie in the winning stocks all together at once and give me an edge on a consistent basis. Entry tactics are how do you get into a stock while managing your risk. So this is all about risk, and we'll get into this when I cover my individual trades later on in the presentation. But your entry tactics allow you to minimize your risk, and they also play into how you can maximize your position size when it matters most in the markets. Because if you don't size up, nothing you do, you might see a little spike and then you give it all back. You might see a little spike, then you give it all back. But if you size up properly when it matters most, you should see these spikes in your equity curve. And you probably heard of a quote in the market out there that says you make large sums of money in the market all at once when the market is cooperative. So these spikes that you create in your equity curve come through position sizing, which again is dependent on your entry tactics to minimize your risk in the market and the edges that winners exhibit again and again. So this is sort of a framework that allows you to perform. So any questions on that, Richard? Be more than happy to take them.
Yeah, I'm not seeing any come through in the chat, but if you do have a question, let us know. We'll be happy to answer it. But I'd love to hear you elaborate a little bit on the routines that you use to, identifying those high potential stocks in different market cycles.
So a daily routine I have is, and I'll break it down into a couple of points here, is you have to know exactly what you're doing at 4 p.m. when the market closes. You should have a workflow of sorts that you run through that workflow and you prepare for the next session and you get away from the desk. A lot of people think if you stay after the market closed and you spend 4 or 5 hours looking at the markets, you're getting tired and you're working hard, it's going to result in performance. That's not necessarily true. With trading, what we're doing is we're paid to perform in the markets. We're paid to execute at 9:30. We're not paid to sit there at 11 p.m. Get very tired, wake up late, and things of that nature. So again, this is a performance sport. So within the daily routine at 4 p.m., I know exactly what I'm doing. One of the things I do is I run a volume scan, which is posted on the TraderLion main handle, which is up on volume. I look at that. One of the recent ones from Ropel is the new highs scan. I go over 3 key watch lists that I have in the markets. So I break down the markets into 3 things, which is the gappers watch list. People call them pegs, big volume gap ups, whatever you want to call it. The IPO watch list and the HCF watch list. I review those watch lists. And then from all of this, what I'm trying to do is I'm trying to get a focus list for the next session. So I go through this routine. It takes me no more than 45 to 55 minutes. And during earnings season, you can review earnings after hours so that you could prep for some of the gappers the next day. But most of this sort of covers my daily routine. I get to a focus list, and then all of this you could say is get away from the desk, because we're making decisions in the market, and our brains, if we just sit there and spend energy at the desk, doesn't mean that we're going to make good decisions. A lot of it comes from building your mental capital and getting away. So when you're back at the desk the next day, an hour and a half before the open, you could calibrate, you're fresh, your mind's fresh, you're ready to make decisions to execute in the markets. Your mind isn't spent being at the desk till 6, 7, or 10 o'clock trying to figure this thing out. So that's what my daily routine is. My weekend routine, so that's the other one. That is, I usually do that on Friday or Saturday. And that, what I'm doing is I'm updating. So one is to update key watch lists. So update those IPO, HDF, and Gappers watch lists. I review, so I'll review the S&P 500, all 500 tickers. I'll look at the IBD 50. I'll look at the NASDAQ. And then I have a few Pacific scans. So if we're in a correction, I'll run the RS new high before price scan. That tells me, what is outperforming in the markets, and very, depending on where we are in the markets, I'll run very Pacific scans for that. I do my weekend routine these days. I make a video for the folks at private access. And then again, I get away from the desk because I want to build my mental capital or do something that's not related to trading, so that things, I could build that mental capital, and then I can make decisions again based on my homework that I did on Monday or Tuesday morning when the market is open. So hopefully that answers your question on the routines. Yep.
Yeah, and we've got a few other questions coming in, but I think we'll answer a few of those later on when we actually talk about your specific trades. But I'd love to hear a little bit more about how you would recommend new traders go about post-trade analysis. How many trades back should they look? How should they analyze previous market cycles, that type of thing? And we'll touch on that a little bit later on with the relative strength new high before price, but I'd love to hear your overall thoughts on that.
On post-trade analysis.
Yeah.
Right. Yeah. So post-trade analysis is basically you're reviewing what you did in the markets, right? You're going back and looking at did I actually have an entry tactic? Did I execute on an edge? And did I position size well based on the number of edges that I had? So PTA is basically reviewing what you did so that you could get better. It's a feedback loop. It's being realistic about what's going on. It's looking at your EC and saying, what the heck is going on if you're continuing to lose money? How do you stop this from happening? So it's sort of a reality check. What I'm doing when I'm doing PTA is one of the things is win rate on a per edge basis. So if the HV edge is making me the most money recently in the markets, then I should be looking for such setups and sizing them a little bit more. Or if the RS edge is working, then I should be paying more attention to that particular edge. So win rate on a per edge basis, you should know that. Folks also like to track their batting average over time. I keep it fairly simple. I look at which edges are working, which is not, and I try to do more of what's working for me. You could do your average winner over the past 20 trades. So that is it a market that you should be scaling out of, right? For example, if your average winner over past 20 trades is 5%, for example, then if you have a gain of 5% on a stock over the past 20 trades, the market's telling you that your average winner is also 5%. Then why the heck would you not scale out? Because the market environment is such. So average winner over past, 10, 20 trades, depending on whatever your goal is in the markets, that's a key metric to know at all times as well. So I would say these three things are fairly important when you're doing post-trade analysis. And also, a lot of people tend to highlight problems in the market, but they don't have no plan on how they're going to go fix that particular problem. They don't have a framework. I get stopped out too quickly. I keep losing money when I'm executing on this particular setup. Well, don't use that setup. Maybe you need to study it a little bit more. So focus on problem solving. It's easy to lay out a problem and say, this is a problem in my trading. It's another thing to go out and actually do something to fix it or mitigate it or do less of as well. So PTA for me sort of boils down to three of these things. And as you build experience, you could feel, what type of market it is. You develop a feel for what kind of environment it is. You develop a feel for, okay, I know my average winner. So you don't really look at all these stats, punch them in an Excel sheet. You sort of have a feel in the markets that you get that feel through experience. It's not going to happen through 1 to 3 months or following someone on Twitter or things of that nature. It's going to come as you lose more money or have more losses. Every loss will teach you something so that you could get better in the markets.
Perfect. And at this point, Ray, did you have a question you wanted to ask everybody watching, or a poll that you wanted to ask people?
Yeah, I mean, what I wanted to ask was year to date performance. What do they feel? How have they been performing? What is it that's stopping them from performing? If you've been in a cash position and you're outperforming, if if you're in year 1 to 2, it's okay to look at the Nasdaq and feel good about, Nasdaq's down 13-14% and I'm only down 3%. But if you're past that, 3 to 5 year in the markets, then you should be outperforming. That should be your bottom line expectation. You shouldn't be happy that you're negative on the year. So maybe folks can type in, how they've been doing, state a problem that they have, how they're going to go fix it. What is it that's stopping them from performing? Writing it all down so that they can go and actually solve that particular problem rather than just talking about it again and again. So
Absolutely. Yeah. And coming back to the routines, I've made a few videos that are on the TL channel about creating a routine, and those can be kind of foundations that you can build off of, make it your own and everything. But Nick, I know you're here watching. Maybe you could link those videos down below in the chat. That'd be super helpful. I think if you don't have a daily routine, weekend routine, that's a really important step to becoming more serious, more professional about trading. So I'd highly recommend setting that up. That just helps improve your overall consistency and just improves your process overall. So yeah, with that, Ray, I think we can move on to the next slide.
the second question we had in the comments was position sizing. It seems to be, this really dictates your performance at the end of the day. You want to size up. When you're right, you want to size up big. And when you're wrong, you want to have the most, minimal size in the markets. So the way I break it down is, again, this first part of it is, what is your edge in the markets? If you don't know what your edge is and you're just going from setup to setup, trying to execute in the markets, then you're acting on something that's random. And Ryan Pierpont recently had a really good tweet on this, is that randomness is going to put you in the poorhouse of trading. So you want to get away from being random in the markets. It's not, you can't wake up and just pick a random stock and start go trade it. You must have a definitive edge or a setup in the markets that you continuously execute again and again and again, so that you can draw an income from it. So that's, what is your edge in the markets? You should be very clear about that. You should have a list of edges. For me, it's, at Private Access, we talk about this BPIP concept, which revolves around the market. We talk about RS. We talk about different HV edges. And these are, bread and butter for me. Every time I see these, I know I could draw, and extract an income. For example, Bill recently. When I saw Bill, I know I can make money from that setup. When I saw Amazon recently, I know I can extract money from that setup if the market's cooperative. So all of these have the HV edge in common, and it's really no rocket science. You see it; it's called visible accumulation on the charts. Anybody can go out there and go study it and build an entry tactic around it as well. So the second part of position sizing is entry tact. So where on the chart are you going to enter so that you can minimize your risk in the markets? At the end of the day, it comes down to, you have to have the way you enter Bill or the way you enter Amazon has to be in a way that you can minimize your risk in the markets. If you can't do that, or if you're taking on too much risk on a per trade basis, it's going to be fairly hard for you to perform in the markets. So what happens is, so we have edges, entry tactics that bleed into position size. Now, if you have multiple edges and entry tactics in the markets, then you could position size that particular name a lot bigger. And we'll get to this as I cover specific examples or my year-to-date trades, is when I see multiple edges. For example, a name has the HV edge and the name has the RS edge, and the market is cooperative. Now, I really have no excuse to size that name up or size that sucker up so big that it could create some sort of spike in my equity curve if the trade goes my way. Now, if I only have one edge in the markets, I don't have the market. If I only have one edge, I don't have the markets behind me, then my position size should be reflective of the environment that we're in. And at that point, it should be lower, so that if you were to lose money, you don't lose money like that. Where your EC, this is your equity curve, it just caters down because you didn't listen to the number of edges that you had, and you didn't calculate your position size based on that. So I use this fairly simple framework for it. People also use this R methodology that you could go out and take a look at. Dr. Van Tharp, his book is fairly great on it. I keep it fairly simple. If I see multiple edges and I could stack them up and I have an entry tactic that I could minimize my risk on, I will position size that name 25, 30, 40%, and at times even 65% in a single session to make that big, that big progress. And I'll show you guys my EC. You'll see these sudden spikes where I'm making a lot of money at once, and then it goes, sort of hibernates, and then I'm making a lot of money at once, and then it hibernates again. So that we'll get to that in a later slide as well. So any questions on position sizing?
Nothing specifically on position sizing. There's a few from Jason talking about specific trades on Amazon and Bill, but I think you might cover that later, so we'll leave it there. Yep. But also at this time, I'd like to say, if everybody could please go ahead and leave a like down below if you're enjoying this stream, and of course subscribe if you haven't yet to the TraderLion channel. And currently, we're also running a President's Day sale on private access, the swing trade masterclass from Oliver Kell, leadership blueprints. So there's a lot of great value, and that link is right below in the description. So go ahead and check that out. I think it ends either later today or at the end of today as well. So yeah, check that out if you haven't yet. And with that, Ray, I'll hand it over back to you.
So year-to-date trades, we'll X out of this, and I will cover some of my recent trades that I've made. Do you guys see TC 2000? Let me know if you do see it or you don't see it.
Yep. Computer hasn't crashed yet, so that's good.
Yep. So this one for me, it's again, what is my edge on this particular setup? I have to be, so first one we'll cover is MDRX. So what is my edge on this particular setup? So this particular bar fit the HV1. What HV1 means, it's the highest volume in over a year with some sort of catalyst that was associated with this bar. So this is visible accumulation. It's on the charts. So I have this edge in the markets. The second one was, as the market came in or continuously came in, this stock is continuously trying to outperform the markets. That's the second piece of the puzzle for me. So now I have multiple edges on this particular name, and I'm sort of allowed to make a trade so that just maybe I can make some money from this particular stock. So the third part of it is, what is your entry tactic that we talked? So we have our edges in line, which is RS HV1. Then we have an entry tactic. For me, this particular entry tactic was just WN, what we call WN, hold number support. So this held the $1.20 mark. There's this HVC area that's another entry tactic, and it also held the $1.20 mark. So I entered this name at 2031 and I sold it into strength. And this was due to the market backdrop. I just didn't feel comfortable with how the action in the market was. So I basically, sold it into strength. And it's it's about $1, but again, it goes down to position sizing. If I position size it well, I could still make quite a good amount of money from this particular setup. So this was one of, a lot of 2022 has not been those 30, 40, 50% gainers. It's been these 4 to 5, 15 to 16 at the very maximum, if you're talking about the long side. On the short side, it's been, like a Christmas party. You short pretty much anything and it works for you, and you make 16 to 18 to 20% from it. So MDRX, again, what I want to show you guys is I have an edge in the markets and I have an entry tactic, and I'm executing on this particular framework again and again, just your draw and income in the markets. So my second one that pretty much everybody on earth has traded this year is Bros. So if we talk about Bros, we have this, the declining 50-day and about the 10-day. So we're sort of building a launch pad of sorts. And it had some, as the market came in, it's exhibiting some RS right in this zone. So it's trying to outperform the markets, or it was starting to outperform the markets here. Market kept coming in. So the S&P 500, This is the green line. So the green line is S&P 500, and the other line is just a ratio showing you how the stock is performing relative to the S&P 500. So for me, again, it was exhibiting RS, and then this was a launch pad of sorts. So what we call that a KMA launch pad, where all moving averages sort of converge. And this is sort of the cause and the effect of this is that the price is going to make a jump or make some sort of directional movement after I enter the name. So again, this was the edge on this particular name. My entry tactic was fairly, if it breaks that through the 50-day and the $50 mark, I'm going to enter that name. Again, that bleeds into how you position size now. And with the way 2022 has been going on, as soon as it, made its rally into 55, I sold all, half of my stock on that initial attempt at 55. Later in the session, it came back, broke 55 again, and I exited my full position. And then it made me look like an idiot for a couple of days before coming down due to market pressure. So again, edges, entry tactics, you execute upon them and you position size depending on the number of edges that you have, and you'll see a higher low on your equity curve on a consistent basis.
Ray, before we go to the next one, I think people also would find it really interesting if you talked about, the other side of trading, like protecting, managing risk, managing that initial stop loss, and overall, if you could talk about how tight you usually keep your stop loss, and what would make you exit if you enter based on your entry tactics and it doesn't go the right way.
So if we talk about risk for me in the markets, when I enter these names, a lot of these entries that you'll see is MDRX. I entered at about 2031 area. Bros, I entered 5021 area. Zim, that is up on the screen right now, I entered $16.30. So there's a common thread here. So $20, $50, and $60. So I keep it fairly simple. If I'm entering a stock, I should have enough evidence. And when I'm entering at 2031, my risk is at 20. When I'm entering at 5021, so bros, if you guys, go to the smaller time frame, 65-minute or 5-minute, you'll see that if you just draw a line at 50, this was a clean break. The market was behind it, or stuff on the Gappers watch list, IPO watch list, and ETF watch list was sort of also green on the session. All of that sort of culminates into me entering that name at 5021, and then I place my risk a couple of cents below 50, so that it's either going to work for me right away, given the market backdrop, how my key watch lists are acting, how things on my focus list are acting, right? Or it's going to fail right away and then push me out. What that tells me is it may need a little more time, or my entry tactic that I have in the market failed. So I'm taking my risk isn't that big. I'm taking a lot of not a lot of factors, but a couple of factors in that give me confidence to enter and have my risk right around this. This would be $50. If it breaks below that, I'll maybe exit at 40.90, 48, 49.85. Here it would be 60. If it breaks below that 60 mark, I maybe exit at 59, 59.85, 59.95 area. So I'm keeping my risk fairly minimal. And I expect the stock to make me money. I'm not expecting there to, sort of sit around and see if it works, then hope a little bit. And then the stock is now trading at $45 and I'm still hoping a little bit. That's just not the way I go about it. I'm expecting momentum to come through and the stock to make me money right away. Now, is that day trading? No, it's not. I mean, I held bros for a couple of days. It's just the market environment is such that if you don't sell strength and your average winner over the past 20 trades is telling you that it's not going to be more than 8 to 10%, then it's foolish of you to sit there and say, bros is the best company ever. I'm going to hold until it's up 25% and then it's going to build another base. That's a fairy tale story that might work in a good market, but it's not going to work in this market because you haven't looked at your average winners over the past 20 trades. So I'm scaling strength based on what the market is telling me, not an opinion that I have that market rates, interest rates are going higher. Fed's going to do this. Russia's going to attack this and all that crap. So I hope that covers for risk management. I'm looking for momentum from my entry area. I'm going to be wrong really quickly because I want to minimize my losses. I don't want to sit there with an 8 to 10% drawdown. And if I'm going to be right, I'm going to be right in a big way. And if I run that through a loop over a span of 50, 60, 70 trades, I should come out on top in the markets. So.
And there's a question about when you're looking to enter a stock, what time frame are you looking at to execute?
So this is another thing that folks discuss. So I'm not sitting there looking at a 5-minute chart. The way I go about it, and I'll tell you exactly how I do it. It's no secret. I look at price, and I look at if it's respecting my levels. So when the market's open, the daily chart's already in my head. The weekly chart's in my head. I know where the stock is on the chart. I don't need to look at a chart. I'm trading levels at that point. When the market begins, or when the market begins trading, I'm more interested if my levels are being triggered to the upside or the downside. So I'm not sitting there at a 5-minute. You should have the 5-minute chart in your, or not the 5-minute, the daily chart in your head. You should have the weekly trend in your head. All that is done when the market is closed. When the market's open, I'm executing based on levels and not sitting there on a 5-minute chart. I would say that's completely different than what folks out there are doing, or maybe they're not. Maybe they're doing the same thing as me, but this is what I'm doing. I'm looking at levels of interest when the market's open. I'm more interested in how stocks are acting on my key watch list. I'm not sitting there looking at a daily chart because I should have done that when the market's closed at 4 p.m. to 6 p.m. when I'm doing my daily routine. So I'm looking at levels, not time frames.
Yeah, I think Oliver in his masterclass, he mentioned he's only going to look at an intraday chart if there's a setup on the weekly and daily. Otherwise, there's no point. You're not looking at the 5-minute chart looking for setups in something that's not ready on the daily and weekly because that's not how he trades. We're looking for moves that can last days and weeks in a good environment, not something that can last 15 minutes or an hour.
Right. I mean, for me, I operate on, I don't know what the market's going to do next. If I find a stock and it works for me, that swing trade can turn into a position trade. I'm more than happy to hold something for a couple of weeks to a month. That was what we did all of 2020, right? That's what everybody did. Everybody was a position trader because things were moving 40 to 50% in a span of 3 months. Now the market's not doing that anymore. So if the market's not doing that, and I have to, if you want to call it day trading, or if you want to call it swing trading, which is almost day trading, doesn't matter what you call it, the market will dictate how long you stay in something, and the market will dictate how soon you have to exit. So for example, in Zim, the only reason I sold on January 13 was everything else in the market was not acting well. And it was just Zim trying to, show strength. Now, at that point, what are my probabilities of this particular stock continuing to hold when the market around it is not acting well? So I just sold it into strength. I don't care if Zim just becomes the only leader in the markets and goes to 120 without me. It just doesn't cross my mind. What crosses my mind is, are the probabilities with me, or are the probabilities against me? If they're against me, I'm going to exit the stock. I don't care where it is on the charts. I made $4 per share on this trade. That's more than enough. And I could build conviction when the market is behind me once again. So for this one, it was, pretty much the same thing. RS, there's another term that I look for, structural basis, which I'll cover quickly. Structural basis is basically this particular base was about 30%, 32% in depth, and this whole base was above that $40 mark. So what I call that, based on several studies I've done, I call that a structural base. So when I'm trading that over here, this gives me conviction that this accumulation in the base depth of this stock, this was controlled action down here, and whoever wants to come back and buy more here, they're gonna, if they were bullish at this point, they're gonna be bullish at this point as well. So I call those structural bases. That's a whole other topic that I could talk about for an hour. And then the BP reclaim, this was basically correlating with the markets. We have this market timing model, whatever you want to give it a fancy name. It's basically a BP IP model that we post daily over at Private Access. And then what we say is, if we're above this BP level, the market is with us. And if we're below this BP level, the trend's going to be under pressure as well. So the market was going on this particular day. You guys could go take a look at the breadth. and things were fairly good on this particular day, and then things turned really sour on January 13th, and everything in the market around Zim wasn't acting too well. And eventually what happens is it sort of comes back in. And that's what I'm trying to avoid in the markets, is this area. I'm more than happy to miss if it keeps doing this with nothing else working in the markets. I have another one. So recently Bill was also a trade. So this one I actually traded multiple times. Feb 7, I traded it and I took a 0.5% loss on it. And the other time I traded was right here at 232. It went through this, what we call HVC. This is the high volume close. It went through this area. And then, again, very similar to Zim market. There's nothing else in the market around Bill that was acting well. So I'm anticipating weakness at that point. I sold my position in Bill. I think it was a Friday, and it was pretty much the only thing. There are very few stocks acting as well as Bill were, but I don't want to hold this only stock and hope that it just continues doing this, because it's not. Because you need the market behind you for a stock to continue to perform well. So this one comes right back into this entry. So I bought 232, sold 252, and my edge on this name was this bar. This is the highest volume since the last earnings cycle, but it's also the highest volume in over a year with a earnings catalyst on Bill. So I entered this name right around here, got a good 2 to 3 day run out of it. Again, what is your average winner over the past 20 trades? What kind of market environment are you trading in? You can't, if it starts working for you, what a lot of traders do is they start hoping, oh my God, now this thing's going to go to 300 and then we're going to consolidate at 300. I'm going to be up 25%. Don't think of any of that. Continue to think from a risk perspective. Can I get a higher EC in the markets? Can I minimize my risk in the markets? The upside will take care of itself when the market's cooperative. So if you're past 20 trades, the average winners are telling you, it's a 6 to 8% type of market, then you can't sit there and just continue to hold this and come round trip it. That's going to cause frustration on your end. You're not going to make any progress. Then you're going to make a mistake in the markets. Then you're going to see a lower low on your EC, and that spiral leads to continuous losses in the markets. So Bill was another one. So I had a loss on it at first. Did a trade, lost some money, and then did another trade, made it back, and then some in the markets. Another one that I want to cover is another loss was Amazon. Again, the idea of it was fairly good. I mean, this is the highest volume in over a year on Amazon. I was operating right around this HVC area. My risk, if I'm wrong, is, max loss, I'm going to take 1.5% if I'm wrong. And then sort of interpret what the market's doing. It ran up fairly good, but then I round tripped this one right back into this HVC area, took a loss on it, moved on. And then sort of the market sort of remained under pressure from there. So I just stay on the sidelines and continue to watch this name. The last bit of it with respect to my trades year to date would be SQQQ. Has been a good one. I shorted around here. You could see the market getting weak after this initial rally. It ran out of steam. So this green line is initial rally, ran out of steam, and then sort of rolled over. I shorted SQQQ. One of the reasons is these 3 times ETFs, they take a lot of fees and they have overhead costs and all of that stuff. So if you short a short ETF, your percentage gain is going to be higher than if you short TQQQ. You could go do a study on it and prove it to yourself, but the percentages, if you actually go and study it, you'll see that shorting SQQQ will yield a better trade. It sort of, that comes from overhead fees. And how these guys structure these ETFs, they have management fees and all of that stuff. So the way these things work, you'll extract a bigger income by shorting a short ETF, if that makes sense. So that was my SQQQ trade. I mean, there's a lot of, this year's been a lot of, so 2022 you know your average winner, scale into your average winner zones. That's number one priority. Uh, yes, you might miss a true market leader, some leader. I've missed hundreds of leaders. All that matters is if you're making money or not in the markets. It doesn't matter um, if you miss a leader or two. When the market environment changes, there's going to be plenty of opportunity for you to go out, catch these 20-30% winners. It's just that's not the case at the moment. So any trades on or any questions on the trades that I've made?
There's a couple. It seems like people are still a bit confused about shorting an inverse ETF and why you think that has a better payoff. They're asking about margin costs, short to borrow fees, that type of thing.
So yeah, you could. So these ETFs, they correlate their exposure, or they correlate with the QQQ. That there's a little decay factor involved in it as well. There's management fees involved in it as well. So if you short a SQQQ versus going long a TQQQ, if you do a study on that, your return on shorting a SQQQ will be higher than going long a TQQQ. That's just it. You have if you go study that and you look at the stats, they work themselves out. They show themselves with the math that you'll be doing. So that is decay factor, that is management fees associated with it. All of that, culmination of all of that sort of results in that. So I hope that makes sense.
Yep, and I think this is a good question to talk about from Jason. He asked, would you be better off staying in cash than trying to press some of these trades given the lack of setups in the market conditions? It's amazing that you can put on that type of size even with just a few edges.
Yeah, I mean, so your confidence in the market comes from how much you study those. So when I see a bill, um, when I see a bill, the first thing that goes through my mind is it's time to make money. Like when you see this bar, when I've seen enough of these bars that tell me that if the market gets slightly cooperative in any way, shape, or form, this thing should go out of here. This should get away from this area and just go. So when you see enough of these and you get a good day in the a day, even a day or two in the markets, you know that this thing's gonna keep going. But it, I forget what the question was, but it's you have to study the edge. Even like I'm constantly executing on a basket of the same things. It's nothing fancy. Um, it's literally these things again and again and again. I see them. I know that I have an entry tactic. I execute on that again because I've studied it so much and I've seen so many examples. I've charted so many examples. I have binders of these things with examples on them. I can connect Bill to 10 other stocks that I've seen in the past that did the same thing in a certain market backdrop. And then I'm connecting, my current state to a past state that leads to conviction. I could position size it and extract an income. So a lot of this it might sound, I have very little edge in the markets or very few edges in the current environment. But when I see them, I'm executing on them. I'm not quite, if you're questioning yourself with regards to if you have an edge in the markets or you don't, that means you don't have an edge in the markets. And it's as simple as that. So if you study these, it becomes second nature to you. You've seen examples, you've marked them up. You're just doing this again and again. Because at the end of the day, you have to extract an income from it or have that mindset that, yes, I've seen this before. I've been in this situation before. Now is the time to execute it so I can perform.
Yeah, perfect. Do you want to hop back over to the presentation or was there more on these trades that you wanted to talk through?
With respect to the trades, I mean, I think that was pretty much, at least that's what I wrote down. My bad, I X'd out of.
Yeah, no problem. While Ray's getting everything set up again, please go ahead and leave a like on this video, this live stream, if you're enjoying it. And if you have any other questions, let us know down below in the chat. We'll try to get those answered for you. And also, just to remind you, we are running a President's Day sale. So if you want to learn from Ray more on a daily basis, you can check out the private access discount. And we have some great discounts as well on the Swing Trade Masterclass from Oliver Kell, as well as some of our other products at TraderLion. So go ahead and click that link. It should be just below, down below in the description. And I'll actually go ahead and copy that over in the chat as well. So let me actually find that.
So that was a year-to-date trade. The last one I didn't cover was Ford. I mean, we're all watching Ford, and we know what happened. I mean, things with larger floats tend to move slower. They may when they're the biggest gainers in the markets, things like like all these sluggish Ford, GM type of names, you know the market's about to be in trouble. So that was the last one. I mean, I traded at $20, sold it the same day for about 40, 50 cents. The thing with these big floats, I think it floats in billions. It's very hard to move stock. It takes a lot of volume, and that's not rocket science. If you heard that before from someone else, what they did was they read how to make money in stocks, and so I encourage all of you to go buy this. It's $20. Has a lot of knowledge in it. Has a lot of timeless concepts. So if someone's taught you that low float stocks move a lot more than stocks with billion-dollar floats, this was written back in 1970, 1960, or whatever you want to, or whenever the first release date of this particular book was. So this was a really good read. It will give you that structure in the markets, or that base,
the foundation,
the foundation, so that you can come up with your own edges and entry tactics and sort of build off of this great foundation that's in this particular book. So we'll go back.
If anybody watching hasn't read How to Make Money in Stocks, go ahead and pick it up. That's probably the best ROI you'll ever have. Go ahead and read it. It's going to be really, really helpful.
I would say 95% of this stuff you see on social media stems from this book, just given a fancy name. So if you actually go read the source, the creator of it, what they said, the foundation they laid out, it's much better than listening to someone that you don't even know on social media. This next slide, what I want to cover is this EC mindset. So this is year to date. I mean, this is your date. So as time goes on, this is your money. This is a super cropped image of my EC. But what I go for in the markets, this EC mindset that I talk about, is these higher lows. Am I making progress in the markets? So I'm making large amount of money all at once. So that if the market's cooperative, size up, make money. Market's not cooperative, stay sideways. Make sure this low is not violated. Market's cooperative, this is your other low. Now I can't violate this low. That if I do violate this low, what that means is that the market is not ready for me to make money in. So this EC mindset is all about higher lows on your equity curve. The same thing here. Go cash for a couple of days, see a cooperative market, size up, operate on entry tactics and edges. You make progress. Now this becomes your low. If the market comes back in and completely violates this, something's wrong with the market. Get out of the way. Don't have an opinion. You're not better than the markets, even though you want to be. All that is ego, right? So now this is the same thing. Again, the market's not cooperative. Stay low. Let the market figure itself out. As soon as I catch I see the market about to get cooperative, you size up again, get through this high. Now, this becomes so higher low on your equity curve, and you'll make large sums of money at once. You won't make, there's no such thing like this in the markets, unless you have some edge that I don't know about. You could teach me as well, but there are going to be periods where you have to stay on the sidelines, and there are going to be periods where the market's cooperative. You make money when the market is cooperative. You don't make money when the market's not cooperative. It has nothing to do with your excellence or whatever you think you could, it has everything to do with the market and what it's doing. So the sooner you come to terms with that, the better you will perform. And this EC mindset's all about, can I get a higher low on my equity curve? Can I continue performing? And you run this higher low through its paces over a year, you can get to triple digits in a good year in the markets. You can get to a really, really good year if it's a 2020, where you constantly, you maybe get a 1 to 2 day pullback, then you keep going. So a 1 to 2 day pullback, and then the market becomes cooperative again. But 2020 was 2020. It's not going to happen for another decade. So this mindset, the sooner you develop it, these are real results that you see. Am I making money? Am I not making money? Am I doing something that is working in the markets? Am I doing something that's not working in the markets? So be realistic to yourself. Get this feedback from your equity curve and operate on that basis, because it will tell you if the market's good or the market's bad.
I've got a question, Ray.
Yep.
I'd love to hear you kind of describe what other equity curves might look like if you're kind of a boom and bust trader or in the just beginning the consistency phase, that type of thing.
So I think we have a fairly good graphic on it. So, but I mean, boom and bust trader, what you make large sums of money, but then you really don't have anything to stop you from yourself. So you give it all back and then some, right? And then you make a whole bunch of money. You're really good. You feel really good, and then you don't have something to hold you from yourself, and you keep going. Basically, your trend is down in the markets. So what I'm trying to emphasize in this is just if you just focus on if the market's cooperative and you operate on a framework of entry tactics, edges, and your position size according to those entry tactics and edges, you should see these spikes. So um, as if you focus on losing less in the markets, you'll eventually make money from the markets. So it's more so a mindset, because our egos get in the way and we want to hold something that's down 8%. Our the way we look at things is I am right, and the position I put on, I believe in this company, and this company is the best. It's the next Starbucks. Bros is the next Starbucks. If you bought at 60 and it's at 45 now, well, you're in the ditch and you didn't make money. It could be the next Starbucks all at once, but you didn't make any money from it. So um, I don't know if that answers your question or not, but it's
Yeah, my question was more like, what would somebody's equity curve look like as they transition from a boom and bust trader with little process, little structure, all the way to becoming more consistent and then yielding to that performance phase as well.
it's almost like how stocks base. There's a
Right.
lot of emotion when things are basing, and then when it's ready to break out, things tighten up, right? So it's pretty much the same. It's how much emotion is going to show on your equity curve is going to reflect what phase you're in. If there's a lot of up and down, you're that boom and bust trader because you're very emotional in the markets, and that's okay. Like I'm emotional as well. You'll never get rid of emotion, but it, it it's how you handle that, or try to minimize or fence yourself around with some rules to minimize that emotion or that volatility. So maybe if you're a boom and bust, you'll be up and down and there'll be a lot of volatility, but the trend is going to be down. What you want to do is you need to reverse that trend to sort of be like this, because it's never going to be like this, right? So managing emotions, how you manage volatility, how you manage your downside is what differentiates someone in a boom and bust cycle versus someone that's only worried about managing their risk again and again and again. So
Perfect.
the last topic we'll talk about is market corrections. So this particular resource, maybe you can link it
Yep.
down there, but I think
Yeah,
it's
I'll
a good
find it and
one
put it
to
in the chat.
review on how these are corrections from 1980 to 2020, I believe, and we have to update this. But it sort of shows you, what do corrections look like? Nothing new happens under the sun. So nothing new is going to happen in the markets. And you want to connect this current state to some past state and study all of these so that you could see what a correction is going to look like in the markets. And I think this is a really good resource for you to be doing that. The second things that I look for is decoupling days. So stocks up more than the market. A good example of this recently was the NASDAQ was up. NASDAQ up 1.5%. And I think I was looking at NVIDIA and it was up 1.5%. when the market is ready to go, Nvidia is going to be up 5, 6, 7, 8% while the market is up maybe 1 to 2%. When you see stocks that are components of these and the market's just looking for an excuse to go lower, you'll see an Nvidia perform at the same level as the market does. But when the market's ready to go, Nvidia will be up 4 to 5% while the Nasdaq's maybe 1 to 2%, right? So decoupling days in the markets, when we're about to bottom and we're about to take off this up, up on the right side, stocks will be up a lot more than what the indexes are showing. That's usually one of the first clues that you see as the market's about to go. The second clue is stocks start caring less about the market action. So we'll get a gap down on news and you'll see majority of the stocks sort of just shrug it off and they don't care about what the indexes are doing. They'll get scooped up again. And that's a demand being built underneath the surface. So we'll get a couple of these decoupling days as we're ready to get out of this correction, if and when that happens. Watch for these two things. When you see a cluster of decoupling days, stocks don't care about news, don't care about the backdrop, and they start performing on their own merit. And a stock like Nvidia or AMD or whatever, any stock is up a lot more than the market index. That's usually the first sign, or we'll get a couple of decoupling days before we get this large rally in the indexes, which people call a follow-through day. So follow-through day is usually that last flag that's sort of planted in the ground and the index is now performing at the same pace as stocks are performing. That's what follow-through day is essentially. The second thing that I look for, and this is from Ross, is you need at least 2 to 3 groups in the market for a trend to build. And this is something that has worked quite well this year. There's really not been a theme. Maybe we get a setup or two in the markets, but we've not had 2 to 3 groups in the growth space, ample amount of setups since the correction for us to just jam in on all of those names and make a large sum of money. We haven't seen that this year. So ask yourself, if you're in the consistency phase, the best way you avoid this is, what are the groups that are going to lead the market out of this? I can't find any yet. Maybe a setup in Nvidia for a couple of days, maybe a setup in AMD for a couple of days. If you guys remember, a month ago, semis were acting well. We had, a little bit of hope, or, we knew that if the market were to go, semis were going to be the first ones to get out of there. But market came in, semis came in, everything came in at once in the growth space. What started working was oil, energy, gold, and gold miners. So the commodity space working a lot more than the growth space itself. And then the last one that I have on this slide is a statistical study. People love to say it doesn't work in recent times, but it's a statistical study that sort of shows you that the market might, the keyword is might, be ready to go. Or the market, you could start increasing your exposure after you see this particular signal. Recent times, I don't tend to wait for this. I have this feel for the market that I have developed through experience. I look for decoupling days. I look for a reclaim of what we call the BP within our market system or market trend signal, if you want to call it. I look at those things a lot more, and the follow through day is sort of a cherry on top. Okay, now we have a follow through day as well. So this is what I'm looking for in market corrections from a market perspective. And this usually, this framework tends to work fairly well. It keeps me out of the market when I need to be, gets me into the market when I need to get into it. Any questions?
Yeah, I just asked in the chat if anybody has any questions, but let us know on market corrections what to look for. If you have any questions whatsoever, leave them in the chat. We'll go ahead and answer them. But in the meantime, I did make a video actually going through an example from the charting historical corrections. You can find that video on the TL channel. I forget what I titled it, but that should be a good resource to look through. And I highly recommend checking out that document We've got corrections going all the way back to the 87 correction, I believe. So definitely a valuable resource.
If we don't have questions, we will move on to the next one. So this slide is from our leadership blueprints course, and I sort of copy pasted this chart from there. How do you find winners in corrections? So one common thread that I found is these two things, which basically you could sum up into this RS edge. Now, there's no guarantees in the market that this signal or this thing's going to work. But what this does is it gives you a probability or stacks the probability of you being in a winner. Because what RS means is stocks that buck the trend while the market's feeling pressure. So when the market resumes its uptrend, the stock should also resume an uptrend or outperform the markets at the same time. So this is just one of the charts from 2020. I mean, out of the 31-day correction, if we use the follow-through day definition, 61.3% of the time SE outperformed during the corrective phase. So what that tells you is 61% of the time SE was trying to buck the trend of the market within the market correction. And when the pressure lifted, it outperformed the market, and it sort of, I think it doubled and tripled. But the expectation is not to find double and triple. The upside will take care of itself. What the emphasis of this slide is, stocks that exhibit RS in corrections are likely or have a higher probability of performing when the trend resumes. So that's the key takeaway from this is, how do you find winners? I like to run a scan of, I know when the correction started, and I know, you can use the follow through day definition that we used for this particular chart, or you could just use, where you felt the trend was about to start, and you could use this particular date. And I try to look for this RS new high before price and the RS new high, and the amount of time the stock was trying to, buck the trend of the market, the greater that percentage, the better odds that this might be the leader on the next cycle. Again, we don't operate on certainty, we operate on probability in the markets. So this framework tells you that the probability of this particular ticker performing well are greater than others when you run the percentages within a correction. So I guess the next question might be, how do you scan for this? How do you keep track of this? For now, I just keep track of it with a database that I have, but we will have tools coming shortly in the next couple of months that will allow you to sort of do this so that you can scan for something like a 61.3% over a span of time. So finding winners in corrections, look for relative strength, look for clusters of relative strength, right? 19 days out of 31, this stock tried to outperform the markets, and you'll have a good list. When the market's ready to go, you'll have a good list to sort of operate upon that and catch what people call a model book stock, or catch a true market leader, whatever you want to name it. It's all the same thing. Catch a winner in the markets.
Cool. So we've got a few questions here, Ray. First, from Azure, we look for stocks which are showing RS in a down market, but even they can join the other stocks, and he says bleeding, but just start declining with the market. Do you stay away, or do you do quick trades? I guess trade them quickly for short periods.
So stocks that exhibit, so it's one thing to find a stock that's exhibiting RS. It's another thing to find an entry tactic that will define your risk to enter that stock at an optimal point. So if we were to just say this, it respected the 40 mark, maybe, this is a sort of a launch pad setup out of here. Now, if I enter this stock right here in anticipation that it's about to do this, then my risk would be, right around this area. So there's no certainties. Again, there's no certainties that SE was going to go. There's no 100%. That you can't operate on certainties. Nobody knows what's going to happen. So what we could do is we can define an edge, we can define an entry tactic, and we can position size according to what we see, and then the market will tell us if we're right or wrong. And you run that through 50 times over, 60 times over, based on what your framework, your edges and entry tactic, you should come out on top if you have a winning system in the market.
Cool. And there's a question about where do you consider the start of the current correction?
So IBD definition, if you want to use that, is I think 10%, right? 10% off highs on S&P or NASDAQ, whichever happens first is what they use. So you could use the 10% definition if you want to do that. Or the other thing again is that the IP-BP model that we use, when we break below the BP, there's going to be market pressure. So that would be the other way I go about it. But you could use the standard 10% definition that IBD uses.
Perfect. I'm not seeing any other questions come through. Ray, are there any kind of closing remarks that you want to make or that emphasize the main points of today's presentation and live stream?
Sure. So I think what you could take away is, building this mindset or framework. Have a framework in the markets, execute upon that framework. You're repeatedly just doing the same things over and over again. If you're reinventing the wheel every other week, the problem is that you're being random in the markets. And that goes back to that randomness will put you in the poor house of trading. So you don't want to be random. You want to minimize. You want to do the same thing, which is what, the daily routine and the weekend routine allow you to do the same thing so that you could develop a feel and you could do a study on the side. But if you continuously execute on these new found ideas that you think are going to magically make you money week to week or month to month, that's randomness. And that's how you continue to lose money. The second, I hope this was helpful, operating on an EC mindset with higher lows on your equity curve. At the end of the day, we're paid to do withdrawals from our investing account to our checking account so that, we're being paid to perform. We're being paid for our efforts. And if we're not being paid, then you have to be realistic with yourself. If you're continuing to see a downtrend on your equity curve, there's some problem that you have to fix. You have to fix it now. There's no point you continue to lose money and you just let it be. That mindset is just, you're operating on being mediocre, basically. So if you want to excel at something, you need to have a performance mindset and you need to have an EC mindset for you to sort of, do well, extract an income, get paid for your efforts in the markets. That's how I would wrap it up.
Okay, cool. I think we'll leave it there. And like we said, if you want to hear more from Ray and get taught pretty much on a daily basis by him with weekend videos, a live Twitter, private access there is definitely something you should check out. We're running a current President's Day sale. The link is down below in the description. And also I just pasted it down in the chat. Definitely check that out if you're interested. And with that said, thank you so much for joining us on this Monday. If you enjoyed the stream, please go ahead and leave a like down below and subscribe if you're new to the TraderLion channel. And we'll see you guys in future videos and live streams. Thanks so much for being here, everybody.
Thanks, guys. Have a good one.